Everyone, my name is Corey Stackhouse, and welcome to today's discussion on maximizing retirement contributions for your tax savings. In this video, we're going to delve into crucial strategies to help you leverage the limited time remaining to optimize your tax situation for the previous 2023 tax year. As we navigate the next 60 days leading up to that tax deadline, April 15th of 2024, our focus is on empowering you to seize every opportunity available to minimize your tax liabilities while maximizing your retirement savings. So throughout this video, we'll explore actionable strategies across various account types, including traditional IRAs, Roth IRAs, employer-sponsored plans, SEP IRAs, and simple IRAs. We'll discuss contribution deadlines, the eligibility criteria, and the potential tax benefits for each of those associated account types. Our goal is simple: to equip you with the knowledge and tools necessary to make informed decisions and to take proactive steps towards securing your financial future. So let's dive in and make the most of this crucial time together, and let's navigate the complexities of retirement planning and tax optimization to ensure a better tomorrow. Let's get started. Today's video is going to be short and sweet. We're going to cover the 5 different account types mentioned in my introduction, plus deadlines, plus eligibility criteria, plus tax benefits. So let's begin. IRAs, or individual retirement accounts. There are 2 primary types that I'm going to hit on in today's slide. The first one is going to be the traditional IRA. The other one is going to be the Roth IRA. The differences between the 2 are the taxation of the types of the accounts. So by definition, an IRA is a retirement savings account that allows individuals to contribute pre-tax dollars into an account where it can grow tax deferred until the future when you decide to retire and take the money out. A Roth is the opposite. We would be using after-tax dollars going into that account. We're going to have tax-free distributions on the earnings, gains, and the contributions down the road as well with a Roth IRA. Now, contribution limits between the both of them, whether you put it all in one or all in the other, or split it down the middle and do half and half in each type of account, the annual contribution limit is going to be $6,500 for anybody who is under the age of 50. The catch-up contribution of $1,000 can be added to that account in addition to the $6,500 if you're age 50 or older. So $7,500 is the most that each individual person within a household could put away if they have an earned income. Now, there is a deadline for this. For 2023's tax deadline, we can contribute into these accounts all the way until April 15th of 2024. So at the beginning of this, I mentioned we have about 60 days left at the recording of this video until that deadline is going to be met. So if you have not already discussed this with your tax advisor, I would suggest consider doing so if it is something on your radar that might be able to provide you either a lower tax bill today or a lower tax benefit bill in the future. On to the other 3 account types. We're going to talk about employer-sponsored plans, SEP IRAs, and simple IRAs. So let's start in the blue here. Employer-sponsored retirement plans. This is going to be 401ks, 403bs, 457s. There are a couple of other tax codes out there that I won't hit on today. But by definition, these are offered by an employer to employees, allowing them to contribute pre-tax dollars, potentially to receive an employer matching as well inside of those accounts. Now, there are Roth options in addition to this, kind of like the traditional IRA and the Roth IRA. There are some Roth options offered inside of employer accounts, but for definition's sake, I wanted to just mention that the primary purpose is to give you a pre-tax contribution inside of those. Now, the limits are different from these than what they would be for an individual retirement account since they're offered by an employer. And these are, you can do one and the other. So you can do both of them if you really wanted to. The contribution limits for a 401k or an employer-sponsored plan for the year of 2023 is going to be $2,250 or $22,500. The catch-up contribution, if you're age 50 or older, you can contribute a total collective of $30,000 or add in an extra $7,500 on top of this $2,250. Again, if you're 50 or older. The deadline for this for most employer accounts is going to be December 31st of the previous tax year, but I challenge you to go ask the HR department what the deadlines are for the contributions inside of your account, because depending on the employer plan, it could vary. Meaning you could have an employer-sponsored plan that does offer you to put contributions in the account after the December 31st deadline. So I challenge you to reach out to your HR department to ask that specific question if this is another tool that could be leveraged to help, again, offset your taxes today or offset your taxes in the future. The next type of account we'll hit on is a SEP IRA. This is going to be, by definition, a simplified employee pension plan. It's for small self-employed individuals that allows them to put away more than what the average individual IRA would allow for. The contribution limits on these types of accounts for the year of 2023 are going to be $66,000 or 25% of your income, whichever is lesser. So for example, you make $100,000, the most that you could put into a SEP IRA would be $25,000, not $66,000, because it is the lesser of 25% of your compensation, or $66,000. Now, the deadline for these traditionally is going to be April 15th, but if you are going to file for a tax extension, what I have found is that you are able to make those contributions at a later date. So let's assume that you make an extension to October 15th, for example. On filing your taxes, you should be able to retroactively add money into your SEP IRA all the way up till October 15th of 2024 for 2023's tax year. So keep that in mind, especially small business owners who are listening to this video. Another type of account is going to be a simple IRA. This is a savings incentive match plan for employees. That's where the acronym comes from. It's a retirement savings plan for small business owners. Employers who have less than 100 employees are what are going to be the qualifications for this type of account. The contribution limits for this type of account are a little different than the 401k. It's going to be lesser. You could put in $15,500 for 2023 tax season if you are an individual under the age of 50. If you are 50 or older, you can add in an additional catch-up contribution of $3,500 for a collective total of $19,000 for 2023. Again, most of these deadlines are going to be April 15th, but if the business files for an extension, you do have the opportunity to add money back retroactively all the way until the business files their final tax deadline. So fun fact for you there. I'm going to stress again the importance of the employer-sponsored plans and getting in touch with your HR department to see if you have the ability to retroactively add money to the 401k for your previous tax year, if that's something that you're trying to leverage to lower your tax bill that you're going to have come this April, or if you're trying to think about your future self and you have some extra dollars that you could put away, maybe into a Roth option. Now, for the SEP and simple IRA contribution deadlines, again, talks with the tax advisor about this, but that 4/15 of 24 deadline is not necessarily applicable. You could have an extension run past that period of time that would allow for it, especially if you are filing your taxes with a Schedule C. October 15th is more or less going to be your deadline on this. If you've made it this far in the video, I have a bonus slide for you. So health savings accounts, I have mentioned this in many other videos in the past, but it is worth bringing up again today because they have a superpower. They are tax advantage savings accounts available to individuals or families with a high deductible health insurance plan. You must be on a high deductible health insurance plan for the year of 2023 in this instance. You must not be enrolled in Medicare, and you cannot be claimed as a dependent on somebody else's tax return. That's a lot of the eligibility criteria around this. If you are going to be eligible, the huge advantages are going to be around the taxes. So whenever you put your money into a health savings account, it gives you a tax deduction like a traditional IRA. Although a traditional IRA, when you pull money out in the future, you have to pay taxes on it. A health savings account, you actually get to pull the money out tax-free, kind of like a Roth, if it's used for medical expenses in the future. These are accounts that you can roll over year to year and invest like IRAs and Roths as well. So the earnings and gains are treated tax-free in addition to that. Now, the contribution limits for 2023, it depends on how your health insurance plans are set up. So if you have only one individual in the household that's on a high deductible health insurance plan, they would have an individual contribution limit of $3,850 if they are under the age of 55. If they are 55 or older, they could do an extra $1,000 catch-up contribution for a total of $4,850. Now, if you have a family that's on a high deductible health insurance plan, your eligibility limits will be higher. In 2023, you could put away $7,750 if you are under the age of 55. If you are over the age of 55 or at least one spouse within the household, you can add the additional $1,000 catch-up contribution to that total to give you a round number of $8,750. Fun fact on this, in the event you have two individuals that are on separate high deductible health insurance plans within the household, they both, if they are over the age of 55, could add a $1,000 catch-up contribution to give them an annual limit of $4,850 plus $4,850, or they're able to put away a total of $9,700 in that instance. So in the event you have both have high deductible health insurance plans and are taking advantage of this, that's one way that you could separate out and put some extra money away to give you an additional tax deduction. The deadlines for 2023 tax year is going to be April 15th of 2024 as well, the same days as what the traditional and the Roth IRAs are. Again, this video is short and sweet this week because we have some deadlines coming up in our very, very near future. April 15th is going to be a day that we're going to pay lots and lots of attention to if you're interested in going over any of the savings that are out there for you for an IRA, a Roth, in some instances, an employer-sponsored plan. Call your HR department, or the self-employed individuals. We're looking at SEP IRAs and simple IRAs. I've went over some of how this is going to help for retirement planning in the future, some of the tax advantages of these types of accounts, the deadlines for these types of accounts, and I want to emphasize that you should act promptly if you're going to make any of these adjustments. Talk with your tax advisor. If you would like any help from our firm, Stack Enterprises, our contact information will be in the description box below. Otherwise, thank you for your time and have a wonderful day.